Happy New Year and welcome to a very special edition of the Weekly Market Wrap-Up. To kick off 2015, we have an exclusive one-on-one in-depth interview with Rick Rule, expert trader in the junior resource market and founder of Global Companies. Let's check in on what he thought of how 2014 shaped up and what he's most excited for in 2015. Joining me now in the studio is Rick Rule. Hey Rick, thanks so much for being here. Let's get right into it. In 2014, what were the three biggest forces that had a positive effect on the market?
When you say the market, I think you're talking about the junior resource market. Is that accurate?
That is, Rick.
Well, perversely, from my point of view, the decline in share prices. I know that's not going to sit well with some of your listeners, but the truth is that if you are trying to get rich in the course of a cycle, you need to buy low in order to sell high. And the fact that share prices, both good and bad companies, declined made them, for me, of course, progressively more attractive. The second thing is also going to be perverse. The fact that many of the companies that competed with me in 2010 literally ceased to exist in 2014 was, from my own point of view, extremely positive. The third, and this is going to be a controversial call, was that my suspicion is that although it may not feel like it, I suspect we may have put in a market bottom in 2014. And in fact, I think we may have put in a market bottom in 2013. You'll recall in our prior interview that we talked about the fact that we were facing a saucer-shaped bottom if we managed to avoid a capitulation sell-off, something with higher highs and higher lows, but sideways action with lots of volatility to terrify us. And that's precisely what we saw in 2014, of course, in spades.
We would expect nothing less from you, but to give a little bit of controversy, Rick. So now, what were the three forces that had a negative effect on the market, the junior resource market in 2014?
I think the continued insistence of people in some quarters to provide sustaining capital for companies that had no real reason to exist. The truth is that the junior mining sector has always been substantially overcapitalized, and we have always, on the CDNX, or TSX, I'm sorry, TSXV, we've always had 300 or 400 or 500 companies that are completely superfluous, which means that we have wasted general and administrative expenditures on companies that were basically employment schemes or fee-generating companies rather than companies that were engaged in legitimate exploration activities. And I would like to have seen the type of clean-out in 2014 that we saw in 1992, which would have set the stage for a more robust recovery. I think the second thing that's had a negative impact on the market has been the sense, mistaken, I believe, in the hegemony of the U.S. dollar and the U.S. Treasury securities. I understand perfectly that the U.S. dollar is a sort of if you will, the prettiest mare at the slaughterhouse, in the sense that if you compare it with competing currencies like the yen or the euro, it stands up fairly well. But if you think about it on its own, in an absolute, I think it's a much less attractive store of value than other people think. I guess the third negative from my point of view has been the widespread acceptance by both citizens or taxpayers and also investors that the correct response to the messiness of a market, including the market of 2008, has been a government response. It would seem that both citizens and investors are relieved that the big thinkers of the world, flooding the world with liquidity, have managed to avoid the solvency question that was in front of us in 2008. It's my own belief that just in the way the TSX Venture Exchange has had a purge, has had a self-correcting decline, that we need self-correcting declines in other parts of the economy too. And I suspect that the political actions that have taken place have stalled rather than eliminated the reckoning that probably has to happen to reset the economy.
You mentioned earlier our interview last year at Cambridge House Investment Conference, where you said, lovingly, that Vancouver is the epicenter of the gamier parts of the resource industry on the exploration side. So knowing the resource market in Vancouver as well as you do and having made money in it, what are your thoughts now at the end of the year, considering that resources have taken quite a beating?
I couldn't be more excited than that. You know, a normal bear market cycle sees median pricing, the good, the bad, and the ugly, decline by 50%. This one, by virtue of the most recent statistics I've seen, is down by 83%. And I suspect if you add in the savaging that the oil and gas equities have taken recently, that it will end up being down by 90%. If you like the sector, and I don't like it, I love it, the idea that you get a 90% off sale is extraordinarily attractive. You know, I was talking to Ned Goodman not too long ago about this, and Ned was reminiscing over 40 years or 50 years experience in the sector. And he said, Rick, you know, when you go over the edge, what happens is that your portfolio declines by 50 or 60%, which isn't pleasant. But if you reposition yourself, if you sell out of the worst of your dross and buy the best of the bad lot at the bottom, the upcycle gives you 500 to 1,000% returns. And if you think about that simple arithmetic over the course of a cycle, you lose half, and then you make sort of, let's call the median 700%. Over the course of a decade, that's an extraordinary trade. And what I would say to your listeners is that you don't have to participate for the full cycle now because you've already been over the edge. You have already experienced the pain. Why don't you position yourself for the gain?
I like it, Rick. So how are these forces affecting the commodities market playing out?
Well, you know, the commodities market is in some disarray. The truth is that markets work. They're very messy, but they work. An example, of course, might be iron ore, or coal, things that have really fallen. They had spectacular decades in the last decade with the growth of China. And the increase in marginal demand couldn't be met in the near term with increases in marginal supply. You can't just turn on an iron mine. So you had a situation where the iron price went up 300 or 400%. But over time, markets work. Very high iron prices did two things. They increased supply over the course of a decade by a whole bunch. And the high prices limited the utility of that iron ore, so they decreased demand. Now you had a crash in iron prices. The truth is, if you're looking for the next cycle, that is, if you're looking to be a buyer, buying productive capacity, if you can find it, that's economic at $70 oil, at $70 iron, exposes you to substantially less risk than buying productive capacity that was economic at $125 or $130 iron. The truth is, in the natural resource business, you have to be a contrarian or you're going to be a victim. It's very difficult, of course, because everybody wants to be a contrarian when it's popular, but there's sort of a contradiction in terms there. You have the opportunity now to participate in a market that almost has to go up because so many commodities are priced in the market below their cost of production. You have also the opportunity to do it with almost no competition because all of your speculative brethren have run off into either technology businesses that they don't understand or marijuana businesses that they understand all too well, leaving the natural resource-based speculations just for you at precisely the right time.
So lastly, before we let you go, Rick, I want to talk quickly about 2015. If you had to say one thing that you are most looking forward to, you've used the words excited, but if one thing that you're looking most forward to in 2015?
Well, I made the same prediction in 2014, and I was wrong, but I'll make it again. I suspect in addition to market capitulation, you'll begin to see issuer capitulation in 2015. Issuer capitulation means that the very best players in the field, the Lucas Lundins, the Ross Beatties, the Robert Friedlands, have to come to market. And they have to come to market at prices that are established by the overall sentiment in the market, which is lousy, which is a different way of saying that the absolute A players in resources have to give the investors a break. They have to issue equity in conjunction with warrants, speculative mana, at precisely the bottom of the market. You can give the money to the best people in the market at the best terms that you will have seen for 10 or 15 years. It's interesting that there's supposed to be something wrong with that. I love it.
Well, Rick, we can't thank you enough. We know you're going to be at the Cambridge House Investment Conference this year in January, so we'll see you there, and thanks again for being with us.
Always a pleasure, Hannah. Thank you very much for those great questions.
You can always count on Rick Rule to tell it like it is. Great to hear his insight for this coming year. And thanks to you for watching another episode of the Weekly Market Wrap-Up. We're back here next week with a regular edition of the Weekly Wrap-Up. On behalf of our own network news and Baystreet.ca, enjoy the rest of your holiday.